Welcome, everyone, to Tax to the Max. And our special guest this week is Karen Davis. We were having a little fun the other day. Karen has some interesting degrees, which I'll let her tell you about if she has time. She has an MBA, a PhD, but not in tax. She's an enrolled agent and as good a colleague as I've ever found on how to carry the freight of a tax practice, how to get the work done. You know, there are a lot of CPAs floating around that don't have her knowledge of how to get the work done, and I'm glad to have her share that with us this week. So it's Tax to the Max. There is the disclaimer. The most important down at the bottom is my acknowledgement of the help I get from Tax Notes today, published by Tax Analyst. In my opinion, Tax Analyst is the preeminent source of current information for tax professionals, and I encourage all tax professionals to check them out. What they publish has been extremely helpful to me. What's on the program this week? 6 items, counting Karen. Brokerage services disqualify small business stock from a Section 1202 tax break. The PFIC, the Passive Foreign Investment Company regulations, give us an aggregate approach, and one commentator says that makes no sense. I agree with him. A 2022 cumulative list of changes for pre-approved 403B plans. Some of you may be on boards of tax-exempt organizations that are sponsoring 403B plans. You need to make sure this is done correctly. You may have clients that are school teachers or employees of exempt organizations that are participants in 403B plans. They need to make sure that these amendments are done properly to their plans. A transfer of intangibles in a foreign corporation, it was kind of an odd transaction, but the upshot was a United States corporation transferred valuable intangibles to a foreign corporation in which would have been a 351 transaction under US tax law, and was, except for one little hitch. And that's a code section we don't see very often that says if you transfer an asset offshore that has appreciation in it, you got to pay tax on the income outbound. Fast track process for letter rulings is not limited to simple deals. I find that concept fascinating. I wonder how many of us are going to spend over $20,000 in professional fees alone just to get a private letter ruling on a simple transaction. And then, of course, we'll turn this whole thing over to Karen pretty soon. Meanwhile, she's free to comment, and I hope she will. She promises scintillating and practical explanations. Karen, what is that?
Scintillating means it's shimmering with light. Practical means it's useful. So we do it both.
Okay. And the reason that we're doing this is we've had more questions about the child tax credit, the child independent care credit, the health care credit than on any other subject for the last 4 months. And so it seems reasonable to talk about how to claim those credits in this program. Some of you have downloaded the PDF, which Karen made available. That's a case study. She will be talking about that as she goes through her part of this presentation. You will be able to download the case study after the presentation is over. I have it. Send me an email. I'll send you a copy. So we'll get to her case study, but not from SCAPA, from me. I'll do it. Don't burden Catherine with that. Please post questions in SCAPA Connect or in the chat here. We will undertake to answer them as quickly as we can. All questions will be answered. We may not get them all answered during the program, but they'll all be answered. Let's start with Section 1202. The tax break for an investment in a small business corporation, which lets you ignore the capital gain from the sale of stock in such a corporation, but the law is complex. Many conditions and limitations, requires a 5-year holding period. The value of the corporation can't exceed $50 million. The value of the gain can't exceed $10 million. And I chose that array of confusing signs over there just to illustrate how difficult it can be to access this very attractive treatment. Now, the latest amendment to Section 1202 provides not 50%, or 60% or 75% that was available at different times during its iteration, but now 100% exclusion of any capital gains if you acquired your stock after September 27th, 2010. Good news, no portion of the excluded gain is a preference item for AMT. Capital gains that are exempt from tax under that section are also exempt from the 3.8% net investment income tax. What other rules and conditions apply for me to get this special tax treatment? 80% of the assets have to be employed in a qualified small business. So many businesses don't qualify. What is qualified? Well, a brokerage business is not qualified. Any personal service activity, banking and finance, farming, mineral extraction, hospitality enterprises, and that's what got the taxpayer here, was they had a brokerage activity. They were brokering lease transactions. And that brokerage activity, personal service activity, didn't qualify for Section 1202. So could we summarize that Section 1202 benefit is really available for those activities that involve production, wealth creation, something beyond personal services? That's the way I like to think about it. Maybe that would be helpful to you. So here's the guidance. It's in an internal memorandum, internal legal memorandum, legal advice within the service to an agent that's probably dealing with this problem in the field. Went through, you can't include the capital gain on the sale of stock because they were engaged in brokerage services. It pays to read all the little obscure parts of the code, 1202E3A. If you don't read that, you can make a mistake. Now, PFIC regulations, and Karen, feel free to jump in. Tax notes today, I picked up an article by Monty Jekyll. I'm sure, Karen, you've read his comments. He's the go-to guy on partnership taxation for a lot of Washington tax experts. Last week, we reported on a set of regulations applying the aggregate approach to reporting income from a passive foreign investment company. This ties into something we're going to talk about next week, which is the introduction of Schedule K2 and Schedule K3 for partnership tax returns, and a determination by a lot of bright accountants that you may be required to produce a Schedule K2 in addition to a K1, even though none of your partners have an investment in foreign corporations. If the partnership has an investment in a foreign corporation, or perhaps if some other partner has an investment in a foreign corporation, you may be required to produce a K2 or a K3 to go along with your Form 1065. They don't do anything to make this easier year after year. So Mr. Jekyll, the go-to guy, expresses concern over how the IRS will reconcile the aggregate treatment of items reported to the partnership with a proportionate ownership. And he asks the question, proportionate to what? Proportionate capital accounts? Proportionate profit sharing? Proportionate some other sharing? I have no answer. Sometimes we just have questions. That's how the tax business goes. 2022 cumulative list of changes for pre-approved Section 403B plans. It's just important that you know this notice has been published. Make sure that if you have any association with a 403B plan, either you're on the board of an organization that has a 403B plan, or you have clients that are participants, make sure that the plan is updated for all the cumulative changes so that it remains a qualified plan. A botched 351 becomes taxable under 367. And sometimes I don't find the appropriate illustration in clip art. This time, I believe I did. This is a corporation, they were involved in a cross-border reorganization. That is, some assets that were owned by a US corporation wound up owned by a foreign corporation after a tax-free reorganization. Everything should have been tax-free, except it wasn't. One of the assets that was effectively transferred to the ownership and economic benefit of the foreign corporation was an appreciated intangible. Code section 367 says that's a taxable transaction. So 351 says tax-free incorporation, no problem. Transfer assets in exchange for stock, tax-free if you follow all the rules, but you have to keep reading. 357 says if you transferred to a foreign corporation, then you have to measure the value of the assets that are being transferred. And if there is appreciation in those assets, it's a taxable transfer. Income determined as if that asset, that appreciated asset, was sold for its fair market value. And you had better do a good job of documenting the fair market value. That's not something where you want to be loosey-goosey. You need to have something in the file to which you can point, and we expect the IRS to join you in your reliance. It's an outbound transfer of a valuable intangible. Here's the citation: TBL licensing. Tax court found they constructively transferred intangible property. How much? Had a value, appreciated value of $1,274,100,000. I don't know how they get the final $100,000. The tax, $504,691,690, worth the legal fees, but I'm sure they'd rather not pay them. Next and finally this week, for my part, the fast track process that we talked about last week is not limited to isolated issues or simple deals, except by the amount that you're willing to pay a professional to prepare a request for ruling and the amount that you're willing to pay for the ruling. Some rulings, the user fee to the IRS is now over $30,000. Never mind what you have to pay the CPAs and the lawyers to get the ruling request together. So the IRS is making a big deal about this fast track program is available. That's important. If I've got a deal going for a corporate merger or an acquisition and tax considerations are important for that deal, I want to get some consideration. I want to have some comfort. And so I'm willing to pay for a private letter ruling. Maybe I'm going to have to settle for an opinion from my law firms, but then I may want to have tax insurance, which I can buy by paying a premium to an insurance company. We talked about that about a month ago. So no matter how complex the transaction or issues involved, there's no requirement to have a good reason or any reason at all. If you're willing to pay the freight, the IRS is committed to an 18-month turnaround from the time they first assign it to an IRS review team. I looked at that and I said, well, okay, how long is it going to take them? I'm such a skeptic. How long is it going to take them to assign it to a review team? So maybe I wasn't as comforted by that as I should have been. And now, my good friend Karen Davis.
Lynn, this is Tony. Can you pause for a second?
Sure,
You
Tony.
made a comment about schedules K2 and K3. We got an opinion from BDO. We're affiliated with BDO. They had an opinion this morning that the K2s and K3s need to be attached to every S corporation partnership return, irregardless of whether or not they had any foreign activity or ownership. So I don't know if you heard anything.
BDO is of the opinion that we're going to have to file those anyway,
Yes.
regardless. Yeah, I read something about that this morning myself, Tony, and I thank you for that input. It's another complication. We'll cover it next week, and maybe during the week, Tony, we can exchange some emails about that. You can help me?
Sure. If I get any more guidance from those folks, but again, that's what
So
they
now
advise.
here's what's going to happen. I am going to, let's see, how's this going to work? I'm going to go out to participants, and I'm going to go to Karen Davis. I'm going to go out to more, and I'm going to make Karen Davis the host. Karen?
Okay, I'm glad to be
I'm
the host.
changing you. I just changed you to the host. I'm going to stop sharing my screen so
All
you
right,
can
there you
share
go.
yours.
Okay, so I'm going to do screen share. And I'm going to click share. So what we all should be
bingo.
seeing. Did that work?
It's not perfect, but it'll work for our purposes.
How good are we? No, I think I can go slideshow from current slide and then it'll be perfect. So let's try
Yes.
it.
Yes, slideshow
slideshow.
from current slide.
Yep, from current slide. All right, so here we go.
Perfect.
This is good. So in order to understand anything about anything, I always try to do a tax return. So the past year, because of Congress leaping into the breach of the COVID emergency, we had several significant pieces of legislation. First out of the box, the Families First Coronavirus Relief Act, the CARES Act. At the end of 2020, we had the Disaster Relief Act, and then in early 2021, the American Rescue Plan Act. These all contain significant provisions, many of them hitting the 2021 tax returns. So that's why it matters to us now. So what I want to talk about, and if you have downloaded or have gotten yourself the sample tax return, I put together a comprehensive sample tax return for a taxpayer who would have all of these things, the increased child credit, the increased child care credit, an enhancement to the premium tax credit, and then also going back to 2020, the option to spread out a qualified coronavirus-related disaster distribution from a retirement plan. So all of these things now impact how we're going to prepare 2021 tax returns. The first thing on our radar screen is advance payments of the child tax credit. The IRS had sent a letter back in June informing people of what would be their advanced child tax credit amount. And the IRS got to work building these interactive portals so that people could modify their family size, make changes to their filing status, make changes to their income. And I never recommended to my clients that they get involved in the portal. You know, if you're getting an amount and it's too big because you didn't want it, just go ahead and increase your withholding elsewhere. If you're not getting an amount but you wanted it, go ahead and decrease your withholding for a bigger take-home pay. The portals did get up and running. They were useful for a lot of taxpayers, but for my purposes, I didn't want to be interacting with the portals. Now, even better, in January, the IRS sent a letter 6419, and that tells individuals what was the amount of the advanced child tax credit payments they received, but also how many children were taken into account. The important thing to know about this letter is you need this letter. You'll take information from this letter and put it on Schedule 8812, which is where the child tax credit will be calculated. And if you have the wrong number, that return will be pulled for manual review, and it will be months before your client gets their refund. This is how we've spent all of 2021 is where's my refund for 2020 if the amounts of the economic impact payment number 1 and 2 were incorrect. Those got pulled for manual review. The same thing will happen with the child tax credit. So make sure you have this letter from your client. Also, in the case of a married couple, both taxpayer and spouse got a copy of this letter. Most likely, each of them were indicated to have received half the amount. However, it's also possible that one of the spouses opted out and the other stayed in, and so they won't be the same amount. So you absolutely need both letters in order to correctly prepare a tax return and not have the refund held up. So the IRS put together a fact sheet with FAQs for the child tax credit, excuse me, and advance payments of the child tax credit. There's 14 topic areas, and at the bottom of this slide, I've shared with you the link to this fact sheet. And you can see, you know, I've just sort of pulled out some of these 14 topic areas for where these are the questions I think you're most likely to be getting from your clients. It's a tremendously, you know, sort of robust set of questions and answers. Now, what's interesting to me is at the beginning of the fact sheet, there's a disclaimer. And it says, because these FAQs have not been published in the Internal Revenue Bulletin, they can't be relied upon, and they won't be relied upon by the IRS. Instead, the IRS will use its best understanding of the law. However, if you reasonably and in good faith relied on these FAQs, there'll be no accuracy-related or negligence penalty. I've put here in bold at the bottom a reminder, don't forget the Paid Preparers Due Diligence Checklist Form 8867. That used to only be relevant with respect to the earned income credit, but over the years, as you know, the IRS has expanded it to include the child tax credit, the education credits, and also head of household filing status. So we as preparers have been asked to really affirm the due diligence that we put into these returns, even if we know our client well, excuse me, and it's obvious, and the software is just going to like default answer all these questions anyway. Go ahead and take a look at that and make sure that you're getting answers to those questions that you're willing to stand behind. I'm going to share with you some of the Q&A from the different topic areas. So topic area A, question 3, did I need income to receive advance payments of the child credit? And the answer is no. And the reason for that is that the child tax credit will be refundable in 2021 for everybody. It doesn't require earned income. What it does require to be a fully refundable credit is that you lived in the US or Puerto Rico. So there are questions about that on Schedule 8812. Now, Schedule 8812 in previous years was used only by taxpayers who were claiming a refundable portion of the child credit, and the child credit itself just went on, straight on to the 1040. But this year, all taxpayers claiming either the child tax credit or the other dependent credit, $500, will be filing Schedule 8812 because we have to reconcile these advance payments. We have to determine whether the taxpayer has the option of the refundable or is it non-refundable. But also, importantly, that form on page 3 does a calculation that if you received advance payments of the child tax credit in excess of what you were entitled to, some portion of it may have to be paid back. So that's why we have such a robust set of Q&As. So here's another one. Who was eligible for advance payments of the child tax credit? You have to have had your main home in the United States for more than half the year. That would have been the requirement to receive these advance payments. Here's another one. This is an important one. My payment was issued, but I didn't receive it. What can I do? Well, I will tell you, I'm still tracking down EIP3 payments that never arrived in the mail. What do you do? Where do you find it? And they give you some advice. If it's been 5 days since the deposit date, you can put a trace on it. Form 3511 is used to put traces on checks that have gone AWOL. But the thing that I like to do is to pull an account transcript of the client. So these payments, there's no more advanced child payments being issued. There's no more EIP3 being issued. If these checks were not issued and not cashed, and you've put a trace on it and it was never cashed by anybody, not just the taxpayer or anybody it got misdirected to, in that case, the money will have been redeposited into the tax account for the taxpayer and available then as a credit on the tax return. If it's the EIP3, it'll be the recovery rebate credit. Otherwise, in this case, the child tax credit. But I think good practice is you're going to want to see an account transcript either because the client has set up an online taxpayer account and pulled the transcript for you, or you got a power of attorney and called the IRS. So this is not something where I want to spend all of 2022 answering the question, where's my refund? Which is how I spent 2021. It's important to get these amounts correct. Again, more about the process. This is topic area E, question 2. How did eligible individuals receive their advanced child tax credit payments? What was it based on? It was based on the most recently filed tax return, banking information from that tax return, or listed in the update portal, or from a federal agency such as Social Security Administration or Department of Veteran Affairs, to where you have direct deposits. That's where they would have pulled direct deposit information. All right, here's a question from topic area F. What if I will claim a child on my 2021 return, but did not claim that child on my 2020 tax return? So that would have been a chance for you to go to the portal and add the child, right? You can state that, well, there were changes.
I've taken the liberty of unmuting myself. I'm not going to interrupt very often, but you're getting now into the questions we're getting in practice. I had a child last year, don't have them this year. And I think the questions that are coming up can be part of anyone's practice. It doesn't have to be a high end or a low end practice. The practice of serial polygamy, which we call divorce, has got children between families, and the poor tax preparer has to figure out where these children are and claim them in the right place to get the right credit. So thanks, Karen. I know the questions are coming up and you're going to give us good answers. Thanks.
Yeah, no, absolutely. You're right. So much of this goes back to families. In fact, so much of the COVID relief was focused on individuals and families. So the, COVID pay, sick and family leave, the unemployment benefits, the employee retention credit really was intended to, retain employees. As we see, later on, we'll see the enhancements to the individual's premium tax credit through the exchange. But here's a question. So what if I claim a child in 2021 that was not on my 2020 return? So the IRS didn't know about this child. And I did have calls during 2021 saying, hey, I had a child, should I go to the portal? Should I let the IRS know I'm going to have this child? And my answer is no, because in my practice, my clients are not in need of these advance payments. It's not going to be the difference between, food on the table versus not having food on the table. And what I told my clients is if you want to have, basically in effect, the advance payment of the child tax credit, just go ahead and reduce your wage withholding because you're going to get this credit on the tax return when you file it. But I didn't want to send my clients out to the portals. At first they were glitchy. There were 3 different iterations of the child tax credit portal. And I'm not so sophisticated with online interactions that I wanted to walk any client through this. And recently, on a side note, IRS had been using something called ID Me, which was going to use facial recognition for setting up an online taxpayer account. Just this week, IRS has abandoned that plan because of really extreme concerns by members of Congress and privacy rights advocates about the use of facial recognition and the private vendor who's doing this and how is my identity being secured. The IRS just said, you know what, never mind, we're going to drop that. And I think that's the right choice. Again, I didn't send anybody out to ID Me to get an online taxpayer account. That being said, I am a big fan of taxpayer online accounts because you can do so much with them, pulling account transcripts, pulling wage and income transcripts, but also authorizing a tax preparer with a power of attorney electronically that we would then access through our Tax Pro accounts. So I like online accounts, but for these one-offs, for the child tax credit, I was not sending anyone there. Here's some questions. This next series of questions is really interesting. Were any of my advance child tax credit payments reduced because I have past due state or federal tax debts? And the answer is no. They didn't offset your taxes. But if you now claim the child tax credit on your tax return and it's a regular tax refund, then yeah, it might be held up for past due federal or state tax debts. Another question, were my advanced child tax credit payments offset if my spouse or I owe past due child support? And the answer there is no. So that's the good news. The bad news is, again, topic area G, question 4. Were my advanced child tax credit payments subject to garnishment? The answer is yes. So if you have a garnishment order that's been authorized by a state or local government relating to private creditors, or a court order fines other court-ordered debts, then yes, those payments could have been garnished. So there again, if the client gives you their letter 6419 that was received in January, and there's a number on it of the amount they got, and they said, I didn't get this money, I didn't see the money. It may be that the money was garnished, but what you have to put on the tax return has to match what was reported to the taxpayer and spouse on letter 6419. I'm not going to complete any tax returns with the child tax credit without having that in hand from the client. Or if that letter has gone AWOL, I want to see a tax transcript. Because again, I don't want to spend 2022 the way I spent 2021 answering questions of where's my refund. All right, here's one. This is actually a really good question. topic area G. I filed my 2020 tax return with a United States address, although my child and I live outside of the United States. So I received the letter at my US address back in June saying the IRS was going to begin to disperse to me the advanced child tax credit payments. What could I have done? Well, this is in the past tense. What could I have done? Well, you could have gone to the portal and modified your information so the IRS didn't pay these advance payments. However, if they were sent to you and it turns out you're not going to be entitled to the refundable portion of the child tax credit because you live abroad and you don't have enough tax to, require to make you eligible for the non-refundable portion, you might have to pay some of it back. So the answer is, you could have unenrolled, but the fact is you didn't. So you're going to square it up on Schedule 8821 filed with the tax return. Lynn had mentioned blended families. I received one or more advanced child tax credit payments for my qualifying child, but that child has moved in with her other parent as of early 2020. And what could I have done? Again, in the past tense, what could I have done? Well, you could have gone to the portal, but you didn't. You could also make an agreement with the other parent that you'll claim the child using Form 8332, the release of claim to exemption by the custodial parent, or you could just pay up, right? On page 3 of Form of Schedule 8821 is the option to calculate how much you have to pay back of those advance payments. And then the child's custodial parent who's claiming them in 2021 will claim the child tax credit without having had benefit of the advance payments, right? So again, this was like a 20-page fact sheet, and I found it to be very helpful. And I gave the site to it, and I recommend for people, practitioners, to download it and read it, because you will get these questions or some version of these questions. And very often with clients, first of all, if I know the answer, that's great. But if it's a sort of nuanced or hard question, and I know that my answer is not really favorable or intuitive, I'll just copy and paste into an email, this is what the IRS said, and here's a link to it, so that people can satisfy themselves that, I'm not just sort of giving them an off-the-cuff bad answer, but this really is the best answer. Again, go there, learn it, use it. The questions are very helpful. The answers are very helpful. All right, here's a question. How can the total amount of my advanced child credit payments be greater than the amount of my 2021 tax credit? And the answer is that, this was based on your most recently filed tax return, most often 2020. If you hadn't yet filed on that because you're on extension, then your 2019 tax return. You may have higher AGI in 2021. You may have fewer children living with you. Your filing status may have changed, or your main home may be out of the United States for more than half of 2021. So these changes in circumstance will affect, the actual credit against which these advance payments are being measured. And you didn't go to the CTC update portal to make changes during the year. So here's the topic of repayment protection. If you got advance payment of the child tax credit, it might be that you didn't qualify for the full amount. You will be protected from having to repay some portion of it if you have low AGI. And in any event, the low AGI will phase out over a period. So taking that math into account, you'll do the repayment math on page 3 of 8821. And now here's the example. You claimed 3 qualifying children on your 2020 tax return, but you claim only one of them on your 2021 return. You can receive up to $4,000 in repayment protection. And the repayment protection is only $2,000 for every child. It's not the full $3,600 that you would have gotten for ages 0 through 5, or the full $3,000. So the enhanced version of the child tax credit has to be paid back, but the $2,000 base version that we're all accustomed to is the extent of the protection from repayment. But since only half of it was repaid in advance anyway, the most you got for any one child was 1/2 of 3,600, so 1,800. So the fact of paying back 2,000 per child, you shouldn't have to reach too deep into your pockets for money you never received or you received too much of. You really didn't receive too much more than you were entitled to this protection on. So you can apply for the full protection of repayment to the extent that your AGI is below 6,000 if you're married filing jointly, 50,000 head of household, or 40,000 for single filer or married filing separately. On this next slide, there's a phase out range, right? So the threshold for full protection is where you would begin to have a payback. And the math of the payback is this scale between 60,000 and 120,000 married filing jointly. That would be, the full protection versus the full payback. There's a range during which you're paying back a prorated portion of it. For head of household, that range goes from 50,000 to 100,000. For married filing separately or single, that range is 40,000 to 80,000. Again, this is to protect low-income people from having to repay it. People who are high income will have to repay the full amount. And again, here's an example. You filed a married filing jointly return for 2020. You claimed the child tax credit for 3 qualifying children, and the IRS made an estimate of your total advance payments. However, when you file your 2021 married filing jointly return with your AGI of 75,000, you claim only 1 qualifying child. So you have 2 excess qualifying children. Now, the AGI of 70,000 exceeds your applicable 60,000 threshold by 25%. Your potential full repayment protection amount of 4,000, that is 2,000 for each excess qualifying child, is reduced by 25% to only $3,000 of repayment protection. Again, this math is on Form 8812. And if you look at the materials that I provided as a sample tax return, you'll see I did most of it by hand. And the reason I did most of it by hand is that at the time in January, our software was not yet up and running with the revised forms, 8821, 2441, 8962 for premium tax credits. So it's just now that my software this week is fully able to do this tax return that I had prepared as an example. But like I said at the outset, my only way of learning anything really, apart from reading the statutes and the commentary, is to do a tax return and see the math. Once I understand the math and I understand it in the context of theory, then I feel like I really have nailed it. So here's a question. Why would anyone unenroll? Why would someone choose to unenroll from advanced child tax credit payments? And I love this question because it's a hypothetical, and the IRS is putting it in a fact sheet, like, why would someone do that? And the answer is to avoid having a balance due, right? If you know you're not going to be eligible for the full prepayment amount and you're going to have to pay it back anyway, it would help you to not get it. Other people, frankly, one of the things I've learned over many years of tax practice is that some people like having a big refund in the spring. I used to tell my clients, you don't need a $5,000 refund. You're totally over withholding. So why don't we get you a bigger paycheck every 2 weeks instead of having a $5,000 refund? And the answer my clients would give me is, I can't really save money. So if I want to go on a vacation in the spring, which I do every year, having this big refund is how I've saved my money. So it's a free loan to the government, having such a big refund, but I came to understand and accept that people have their reasons. So, that would be one reason to unenroll from the advance payments of the child tax credit, is to preserve your big refund. But as I mentioned earlier, my advice in that situation would have been, instead of interacting with the portal, just go ahead and increase your wage withholding. More questions. What were the deadlines to unenroll? Remember, these payments were being made the 15th of every month, starting in July. So July through December 15th, you could have unenrolled as of 3 days before the next Thursday, before the next payment, right? So it would be a one-time action that could not be reversed. And I started out thinking that taxpayer and spouse will each have exactly half. And I did speak with one taxpayer who said, no, I unenrolled from this because I didn't want it. And I thought that it applied to my whole family, but my wife was getting payments this whole time and I didn't even know that. So that would be an example where the letters 6419 that the taxpayer and spouse received would have different amounts of these prepayments. And that's question J7. If my spouse unenrolled and I didn't, what would have happened? So if you didn't unenroll, you would have continued to receive half that you were supposed to receive with your spouse, and then the spouse unenrolled. So unenrolling applied only to that individual and to not to both taxpayer and spouse. And that's not something that you would necessarily have, figured out on your own. You just kind of have to do it and see, where the IRS was going with it. It's hard sometimes to think through things from the IRS perspective, but they have their reasons. This slide, thankfully, is obsolete. As I mentioned just this week, the IRS has discontinued using ID.me to authenticate identity when people set up online taxpayer accounts. So this slide is a statement of where the IRS was as recently as a week ago. But now they're not doing this. So the IRS has indicated they're not going to do this anymore. They're going to develop other procedures for authenticating your ID when you're creating an account. And the multi-factor authentication, I've been very impressed in the past with the kind of stuff they come up with. They call your phone, they send you an email, they ask you, here's an address in Pasadena, California. Which of these four is yours? Here's a name of someone who might be your brother. What state does he live in? It's like, wow, how do they know so much about me? But it works, and to the extent that the IRS is successful in protecting people's identity, I'm all for it. But facial recognition is not going to be the way they do it going forward. Shared custody. This is a really good question. This is from topic area L. My child's other parent and I share custody of our child. How did the IRS decide which of us will receive child tax credit payments? And the answer, it was based on who claimed that child on the most recently filed return, most likely the 2020 return. In a situation where the parents every other year claim the child, then one parent is going to end up having to repay the prepayment amount, and the other parent will get the supersized child tax credit for 2021 because they got no prepayments. And that's the example dealt with in topic area L, question 2. My child's other parent and I have agreed that I'll claim our child in even number years. The other parent will claim the child in odd number years. What do we do? So again, I'm just sort of giving you a sense of, I pulled out the questions I thought were most likely to be asked by my clients, and the ones that I wanted to really, put out there for you to have a handle on when you'll get these questions. But again, the entire fact sheet is helpful. A lot of the fact sheet is, what happened last year, because there's no longer an advance payment. There's no longer a need to be interacting with that portal, but understanding what was supposed to happen. I think you'll still be fielding these questions from your clients. A question L3 is just the opposite of L2. My child's other parents received it. Will I claim it? Whoever claims the child on the 2021 tax return is the one who's entitled to the child tax credit. There's no question about that. The advance payments, the question of advance payments at this point, the only thing is how to reconcile what you're entitled to versus what you got. So that does with all the questions. On these next handful of slides, we're going to look at 3 of the forms that are on that comprehensive example that I've included that's available in the materials. These 3 schedules and forms are ones that we're very familiar with, but they're very changed for this year. So Schedule 8812, and sometimes I call it Form 8812. They stopped calling it Form years ago, and now it's called Schedule. I don't know why. So in the past, this form was only used to calculate what was called the additional child tax credit, which is the refundable portion of the child tax credit. If you had enough taxes that claiming the non-refundable portion was everything you needed, then you never filed Schedule 8812. It's for people who had already zeroed out their income taxes to do the calculations to see if they had enough earned income to get a full portion of the additional child credit. Now, for 2021, this same schedule is being used to calculate refundable and non-refundable credits and the other dependents credit, which is the $500. The child tax credit is fully refundable if you live in the US or Puerto Rico. The other tax credit, the $500, is always non-refundable. One thing also to note is that, and this comes up a couple slides from now, usually the child tax credit dividing line is the child has to be under 17, that is through age 16. For 2021 only, it's going to be under age 18. So up through age 17, you'll get a $2,000 credit, or, if it hasn't phased out, a $3,000 credit, phased out due to high AGI. And it's for children, the dependents, age 18 and older, who would be the other dependent credit of $500. It's a new year, so there's a bunch of new acronyms, and as complicated as it got, in the instruction, they told us all the acronyms, right? So refundable child credit, non-refundable child credit, additional child credit, other dependent credit, social security number. TIN is a taxpayer identification number. It might be the adoption TIN or the individual ITIN for people who don't have qualifications for a social security number. So all of these acronyms are now in the instructions because it did get that much more complicated. And here's the 3 pages. I've been saying for a while it's 3 pages. So here's the 3 different parts. Part 1A is the child tax credit and credit for other dependents. So all filers will fill out 1A. Part 1B is filers who check a box on line 13. Well, that box is the box that says you live in the US or Puerto Rico. So that means you're going to get the refundable child credit. So if you checked that box, it's going to calculate the refundable credit. If you didn't check that box, you go to 1C and you get the non-refundable child tax credit. And you can see it's handy that we just learned all these acronyms. Part 2, A, B, and C, that's the additional credit for people who weren't already entitled to a refundable credit. The credit under the old rules might be refundable under these additional child credit calculations. So parts 2, A, B, and C are the additional child tax credit as we have understood this Form 8812 in the past. Part 3 is on page 3 of this form. This is additional tax. It's basically the calculation of excess payments of the advanced child tax credit. Here's some other sort of high points. I had mentioned just a moment ago that for 2021 only, the child tax credit applies up through age 17. Also for 2021 only, it's increased to $3,600 for children under the age of 6, $3,000 for other qualifying children. The advance payments, again, most based on the most recently filed tax return, were for the last 6 months of the year. Now, these amounts that I've just shown are subject to phase out. That enhanced amount over the usual $2,000 begins to phase out at a much earlier point than the phase out of the regular $2,000. So the beginning point of each of these phase outs is on this slide. So the enhanced amounts over $2,000 will begin to phase out at $150,000 married filing jointly and qualifying widower, $112,500 head of household, $75,000 married filing separately and single. So that's the first phase out, is the enhanced portion. So then you're back to good, you're back to your $2,000, but then the regular phase out will kick in at $200,000 if you're married filing separately or head of household or qualifying widower, at $400,000 for married filing jointly. So these phase outs, it's a 2-step phase out calculation. The heavy lifting is all on 8812. So 8812 became very math intensive. In fact, these phase outs used to be on a worksheet that took place somewhere. Now it's actually on the schedule itself. So you'll see the phase out. On this slide, it just restates the importance of letter 6419. You absolutely need to know these advance payments. You need to get it right. It needs to match what's reported on 8812. In fact, on Form 8812, they just go ahead and they print right there in plain language. Let me see if I can find it. Caution. Oops, and there's a different caution. Okay, here we go. This is on part 1C, caution. If the amount on this line doesn't match the aggregate amounts reported to you and your spouse if filing jointly on your letters 6419, the processing of your return will be delayed. That's printed on the form. I didn't just make that up. And they didn't say might be delayed. They said will be delayed. It'll be delayed because even if you electronically filed a return, if there's a mismatch here, it will be pulled for manual review. And if it's pulled for manual review, it will be a very long time before you get your refund because the IRS is still backlogged. They're doing the best they can do to not be backlogged, but they are. In fact, again, just this week, just yesterday, the IRS had said, we're going to stop sending out collection notices. We're going to stop sending out levy notices. We're going to stop sending out notices that say we have a deposit, but we don't have your 2020 tax return. They have finally acknowledged that they're just creating confusion by sending out notices when the backlog is sitting in their pile somewhere. So that, again, is a very, taxpayer-friendly, tax practitioner-friendly acknowledgement by the IRS. They know they're struggling to keep up. They're helping us by not sort of flooding our inboxes with notices. So, but definitely get these numbers right. We only have, let's see how much time we have left. Hold on. We got about 5 minutes, so I'm going to blast through the next two forms. Form 2441, child and dependent care expenses. Here's the most important changes to this form. Instead of qualifying expenses of $3,000 or $6,000, that's been supersized. Qualifying expenses are between $8,000 for one child, $16,000 for two or more. The credit, instead of being a maximum 35% of the qualifying expenses, now up to 50% of qualifying expenses. And instead of phasing out and settling in at 20%, it phases out to zero for high AGI taxpayers. The credit this year is fully refundable for taxpayers living in the US. And there's a new checkbox on this form. If you haven't looked at 2441 yet, take a look. There's a new checkbox that says if your care provider is your household employee, check this box here. There's no more flying under the radar if Schedule H for nanny taxes is required because IRS is definitely asking about that. Also relating to child care, the dependent care credit accounts in 2020, we were given some relief there. If I had put $5,000 into my dependent care benefit account for 2020, but then the daycare closed because of COVID and I only spent $1,000, plans were allowed to be modified so that they could roll forward the additional $4,000, carry that into 2021. So for 2021, dependent care benefit accounts were doubled from $5,000 to $10,500, again, to accommodate these rollovers so that people could spend it down. Also, if the child turned 13 before the funds were used, you can still use those amounts. That used to be the cutoff. They're giving you an extra year to spend that money. Again, because of the COVID emergency, shutting down the daycare centers that we were spending the dependent care benefit accounts on. Last form I want to talk about, and again, this is all part of the comprehensive example, Form 8962, the premium tax credit. There's two huge changes to this form. One of them is there used to be a cliff at 400% of the federal poverty level for your family size. In that case, no premium tax credit was available. The new rule is that you can still get the family tax credit, but you'd be expected to pay towards your insurance 8.5% of your family income. So it's not a cliff. It's, depending if you have enough family income, you'll end up paying more and more of your own premiums, but you may still get the premium tax credit. The other, and this is the third bullet point here, which is massive, if the taxpayer or spouse received unemployment compensation for any week during 2021, the amount of the household income will be considered to be no greater than 133%. Well, that means you're going to get the maximum premium tax credit possible because your copay is zero. So these are extraordinary changes. So that's everything that I've put together that I have to offer. I'm going to stop. Yes.
Thank you so much. If you'll press the button to advance the slides, we'll save our participants the grief of me trying to fumble around and get back on as host. Let's continue to meet for lunch. We will respect your time. We will present material that's useful to the practicing CPA. Sometimes it's on the high end. Sometimes it's on what you might call the low end. Sometimes it's compliance for 1040s. Sometimes it's compliance for complex 1120s, but it's always going to be a good time and it's going to be useful. So thank you. Let's continue to meet for lunch. And Karen, if you press that button one more time.
I'm going to press stop share.
One more. Oh, whoops. That's okay. Well, that is that's our contact information, but it's immediately available. It was on the front end. It's on the back end. You can get copies of the slides, get a recording of the program. I think Catherine Keller and Whitney Lewis are with us from the SCAPA staff. I'm sure that they will be happy to make a copy of the recording available. If that's true, if you just nod your head. If it's not true, shake your head, okay? Whitney, can they get a recording? Whitney says yes. We'll take
It'll
it
be
every
posted
time.
next week, right, Whitney? Yep.
Thank you so much. Let's call it a 3-0 for today. See you next week. Karen, thanks.
All right. Thanks, everybody.